if you try to sort of apply some of the ideas that Karen just raised, right off the bat, without sort of thinking very deeply, I think you can point out two international implications of persistently lower productivity growth that have to do with interest rates and capital flows. And so these are based on the premise that if you are an emerging market, or maybe if you are sort of a small open economy that, where growth follows its own logic, you may not be as affected by the productivity growth slowdown in advanced countries as those advanced countries, right? So let's keep that. Whether that premise is true or not is a question in itself, which José de Gregorio looks at in his chapter. But if you accept that premise for a second, then there might actually be some good news for you, because you are going to benefit from lower world interest rates, which, since your growth is assumed to go down by less, if at all, is going to help your debt sustainability. You're also going to get more capital inflows as investors search for yield, which is going to be very low in advanced countries. And that can be good and bad. It's good if it's used for investment. It's bad if it fuels bubbles. Now, on trade, however, the implications are really much less clear. And the reason is that whether or not you would expect more or less trade depends on whether the productivity slowdown will tend to reduce the tail of firms that are sufficiently productive to overcome the fixed costs of exporting. So this is sort of a well-known idea in international trade. And so that's in that chart that you see there, that would be the tail to the right of the red dotted line, or whether the fact that median productivity, everything else is shifting to the left, is going to reduce that tail. So it's sort of unclear, and the reason why it's unclear is particularly because there are several studies that are arguing that what's driving the reduction in median productivity growth of firms is not so much the behavior of the productive firms in the top, but it's the slower growth of productivity of the less productive firms. So this is sort of a truly open empirical question. And so we have one chapter that basically looked at this question in great detail using firm-level data. So this is by a team of 4 European authors, actually not just 4 European authors, they all happen to be Italian for some reason. Filippo Di Mauro, who is based at the National University of Singapore, Bernardo Motironi, Gianmarco Ottaviano, who are at LSE, and Alessandro Zona Mattioli, who is at the European Central Bank. And so they look at, in a very extensive firm-level data set called the CompNet data set, and they conclude, and it's pretty unambiguous, that we're going to see a reduction in export growth. And the argument is that empirically, there is in fact a positive relationship between the productivity of the median firm in their data set and the share of exporting firms, both across countries and over time. And so slower productivity growth should lead to slower export growth, but not to an absolute decline. So all else equal, you would assume slower trade growth. Now, again, there is a little bit of hope that is associated with mitigating policies. So they go to great lengths in this paper to show that the area, if you like, under that tail on the right depends on policies, and particularly it depends on policies that allow reallocation within countries, that allow labor and capital to move towards the more productive firms. And so they compute the effect that you might get if countries move to best practices on these reallocation beneficial policies. So these are policies that would benefit entry and exit of firm, increase competition, make it easier for labor to move. Interestingly, these are policies that would also as you will see in the next presentation, mitigate some of the consequences of the productivity slowdown, namely on inequality. Anna will talk about that. But here they sort of push these policies as a way of resisting the productivity slowdown. Now, the bad news is that this would be a one-off effect, right? So you can only do sort of a one-off bundle of policies, but of course the slower productivity growth translates into permanently slower export growth. And, you know, the worry is that to the extent that you also think that slower productivity growth has something to do with less international trade, less international competition, there is, of course, a worry that these things feed into each other. So we're getting into a trap here unless we very forcefully resist it. So all I've said so far was under this premise, well, maybe emerging markets are different. Maybe they will resist the trend. And so again, you know, whether or not you think this is likely to be true is an empirical question. And so we have another chapter by José de Gregorio that looks at this empirical question in significant detail. And what he does mainly in the chapter is to look at sort of the past history of productivity catch-up or lack of emerging markets with advanced countries. And so here the story is really summarized in that chart. Let me see if that works. So the broken lines are just GDP growth. So this is not per capita, it's not productivity, it's plain GDP growth. And so here, you know, the stylized fact is that since 1955, when this data set starts, this is from the Penn World Tables, you have had emerging markets consistently grow above advanced countries, right? So there is some catch-up. As it turns out, however, this catch-up is entirely driven by capital and labor as factors, so factor accumulation, and also human capital. And so if you strip out the pure productivity effect, which economists refer to as total factor productivity, TFP, you see that in the lower two lines. And so here, you know, the stunning fact that he uncovers in his paper is that this red line, which is the TFP growth of emerging markets, has since the early 1970s or mid-1970s been consistently lower than that in advanced countries, with the exception of the very recent past, which in fact coincides with the breakdown of advanced country productivity growth, right? So that phenomenon here is essentially what is motivating this entire project. However, you know, the bad news is that even in this very recent period, although at the moment productivity growth on average in emerging market is higher than in advanced countries, you can see that it's highly correlated. And in fact, it's highly correlated roughly starting here, right? So in this early period, which is associated with you know, independence of many developing countries and a phase where, you know, you still had extremely high productivity growth in advanced countries, you do not have much correlation at all. Starting about here, you have a lot of correlation, and the correlation really kicks in this new phase. And so, you know, that sort of leaves you with a pessimistic conclusion, which is, in fact, emerging markets may not be able to buck the trend. And so, you know, from a perspective of a policymaker in developing countries, you know, my take would be that what's going on, you know, without knowing much about that country, without what's going on in advanced countries right now and in the world right now with productivity is probably going to be bad for you. But if you manage to have very strong policies, for example, policies that can deal with capital inflows, that can contain private and public debt, even though interest rates are very low, that can create business dynamism, so even though your productivity growth might be coming down, it remains above that of advanced countries. If you can do all these things, maybe this episode of economic history offers a real opportunity for you. So you might come out certainly better in relative terms compared to advanced countries, and maybe better in absolute terms as well. That was all. Thank you.